Welcome back to this week's Market Wrap, brought to you by Met Coal Junkie. We're diving into the 2-week evolution of the seaborne coking coal market, where structure gave way to sentiment, and sentiment gave way to surrender. The period from June 2nd to the 7th started with cracks, but by June 9th to 13th, those cracks had turned into a flood. In the first week, market tone was still cautiously bearish. The catalyst? A confirmed resale of Oki North by a Chinese mill at $181 FOB to Tata Steel. That trade validated concerns that more cargoes were quietly on the move. Offers dropped from $187 to $181 within days, and the market sensed a shift. At the same time, BHP sold a GYC parcel at $193 FOB, giving a fleeting moment of stability to the branded PMV market. Indian end-user interest in premium brands like Gunyella, and that kept PMV sentiment relatively tight. But it wasn't enough to stop the momentum building around PLV-linked resale pressure. Coke prices in China continued to decline, DCE paper bounced briefly but didn't lift physicals, and the PLV-PMV divergence widened. Traders started pushing back, questioning offer validity, but it became clear the narrative was changing. Then came the second week, from June 9th to the 13th, and the market took a sharp bearish turn. A flood of resale cargoes, led by Chinese mills but joined by Southeast Asian sellers and even Canadian suppliers, washed into the market. Offers for July loading Oki North dropped as low as $175 FOB, with buyers circling but refusing to commit. Opportunistic bids at $170 emerged, yet no one seemed ready to pull the trigger. The historically wide FOB-CFR gap, long talked about, was now being fully exploited. Even Mongolian and Chinese FOB exports became part of the conversation, adding further weight to an already overloaded system. Branded PMV, once the safe harbor, started to lose its pricing power. Even loyal GYC buyers were pausing, reluctant to pay premiums with so many cheaper alternatives available. BHP remained silent through the week, withholding new GYC spot cargoes. That silence only deepened market confusion. Meanwhile, rumors of August Illawarra cargoes started swirling, and the idea of structural tightness in PMV no longer offered the same support it did a week ago. What we're seeing now is a market that's not just bearish, it's demoralized. No one wants to catch the falling knife. Sellers are in damage control. Buyers are in no rush. And until a new trade prints or a major end user steps in, the tone will remain heavy. In summary, Week 1 was about recognizing weakness. Week 2 was about surrendering to it. Now, the market watches, nervously, for the next move. That's it for this week's Pulse Check. Stay sharp, stay informed, and we'll see you next time.